Coming up on today's program, we're going to be doing some Q&A. I've got some questions I'm going to share with you from our audience members, and I'm going to give you some answers, questions about the best place to own income-oriented ETFs. Is it in a taxable account or tax-free or tax-deferred account? Plus, I'm going to answer a question about how large should your safety net be? This is also what I sometimes refer to as your margin of safety. So we'll do all of that coming up next. Stick around. I'm Ron DeLegge with ETF Guide TV. Thank you so much for being with us. We're going to do some Q&A on today's program. Before we do that, be sure to hit the subscribe button and also check out the description section below. I've got tons of resources for viewers like you. I've got free ebooks. I've got a portfolio grading service, and I've also got online classes. Also, if you haven't yet seen any of our other programming, be sure to check out our weekly program called ETF Battles. Plus, I've got an announcement on a new show that we are going to be publishing on this channel, so stay tuned for that. So let's begin with a really impressive chart. I want to show you this one. This one was brought to my attention on Twitter. And this is a chart that shows a 45-year history of how stocks have performed in a few different scenarios. Now, the gray line assumes that you stayed fully invested in the stock market all the time. And you can see that that $100 grew to an impressive $2,000, which is pretty good. But if you were jumping in and out of the market and happened to miss the best performing 25 days, you could see that you ended up with a lot less money. And if you missed the worst 25 days in the stock market, you actually made out the best. You flipped that $100 investment into over $12,000, which is just incredible. Now, how did I come across this? Well, this chart was tweeted out by Mark Minervini. He is pretty well followed on Twitter, and he is a trader. That's his art. That's his discipline. Now, the main problem is that nobody, including Mark Minervini, Mr. Champion Trader, as he calls himself, can accurately predict what days are going to be the best or worst for stocks in the future. Nobody knows, including Mark himself, and he'll even tell you that. Now, here's what I propose to all of our audience. Instead of trying to predict accurately what those worst days are going to be in the market, which are going to be the best days, instead of trying to play that game and focus all your attention on trying to avoid that, why don't you try this instead? Why don't you try, instead of trying to day trade yourself around a stock market correction or crash, as many traders try to coax you to do, I endorse this strategy, which I think is a lot better and also a lot safer. And it has basically, you put in your portfolio in three components or three parts. You got your core, which is your portfolio's foundation, which consists of low-cost index ETFs that hit all the major asset classes. Those major asset classes, in case you're wondering, stocks, bonds, commodities, real estate, right? Next, after you've completed your core, that's your foundation. Think about this, by the way, in terms of how you construct a building. You construct a building beginning with what? Do you start with the attic? Do you start with the ceilings? Do you start with the roof? Do you start with the terrace? Do you start with the balcony? No! You start with the foundation. And so that's your core portfolio. That's the foundation. You'll notice it's the base, right? The next part is the first floor, which is your safety net. Your safety net is the part of your portfolio which cushions you. It gives you liquidity. It protects you. And then on top of that, you've got the attic, which is your non-core portfolio, which can invest in non-core assets like cryptocurrencies or individual stocks, or non-core types of assets like volatility, also known as VIX. Those are the kinds of things that your non-core portfolio can own. It could be strategic. It could also use leverage. It could go long. It goes short. And so this is the balanced and non-dogmatic investment framework that I evangelize on this channel. and then I also evangelize in my online classes and my books. It is what I believe to be an architecturally sound portfolio construction and management method. And I think it'll help you. It's a lot better than playing that game of trying to predict the best 25 days or the worst 25 days and looking at all the charts. I mean, you could do that if you want, but this is a lot simpler. And this, I think, is a much easier strategy, by the way, to implement. Well, here's a question that I got from a Twitter follower. This is from Russell Perry, and he was asking about, and this was on the same thread as the Mark Minervini thread. He's asking about his side cushion. Having a side cushion that's uninvested and being underinvested, he's asking, are those the same things? So for every $5,000, he says, I'm trying to invest, I'm putting $2,500 into high yield savings. Is it not smart to do this in the event that the market goes down? Well, first, Russell, you're wise to have a cushion. And unlike traders, like the ones we previously discussed, who I think have deluded themselves into believing that they've mastered the market, I don't consider your margin of safety portion of your portfolio to be uninvested or underinvested as those folks claim, because it's a safety slice of your portfolio. It's deliberate, it's strategic, and it's constant. It's not accidental. And it's not underinvested or uninvested. It's deliberate. It's there for a reason. It's not the same as an investor who is sitting on piles and piles and piles of uninvested cash who has no plan. So it's not the same. And so you're wise to have a cushion. And those of you wondering, well, before I tell you how large that cushion should be, let's talk about the characteristics of those assets held within your safety net or your margin of safety. So these are the principal characteristics or attributes. They should offer liquidity. They should have principal guarantees. There should not be any market volatility whatsoever, and they should give you peace of mind. So what types of assets qualify? Well, clearly assets like bonds and gold and cryptocurrencies, which fluctuate in value and can lose money, do not count as margin of safety assets at all, because they can and do lose value. So we're talking about completely different types of assets. We're talking about safe assets that, again, have principal guarantees, no market volatility, liquidity. This is the boring part of your portfolio. Assets like savings accounts or bank CDs. It could even be a guaranteed annuity contract. They all have these types of attributes for your margin of safety. And so these are the types of assets or investments that you can use for your margin of safety bucket. Now let's talk about how much should be earmarked for your margin of safety bucket, because this is a question that comes up all the time. Now, to help you determine how much of your portfolio should be earmarked for this particular container, I created a worksheet that's going to help you calculate that precise number. Now, the worksheet's available in the Investor Toolkit book at etfguide.com. And I'm going to provide the link to that book in the description section below. You're going to get your copy. And in that Investor Toolkit is your margin of safety worksheet, which will help you to calculate how much of your overall portfolio, based on your circumstances, should be earmarked for safety. Now, generally speaking, just to give you some rough guidelines, the older you are and the closer you are to retirement, the larger your cushion should be. Whereas if you're younger or you're just getting started in your investments, you're starting to save and accumulate investments, then you can have a much smaller cushion, or what I call, again, margin of safety. But again, to get those exact numbers, and you should know what those are, that margin of safety worksheet will help you. Again, hit the description section below. I've got a link to that. Now, here's a question from another viewer. This is from Paul Fiedler, asking about where's the best place to put or keep or invest in covered call income ETFs. And he cites an example here asking about ticker symbol DIVO, which is managed by a company called Amplify. Now, this particular question was on the thread for our ETF battle, which featured a quadruple header between 4 covered call ETFs. And so the question Paul is asking, and some of you may have this same question, is where is the best place to own these types of ETFs? Those ETFs, by the way, if you missed that ETF battles, I'll provide the link below in the description section, but QYLD, NUSI, RYLD, and JEPI, JEPI were all featured in that battle. And the tax treatment for covered call ETFs can get very, very fangled, Paul. And that's why they're best held inside a tax-deferred account, like a traditional IRA, or a tax-free account, like a Roth IRA, to avoid all of that complexity. Now, if you do decide to hold a covered call ETF inside a taxable account, and some of you have made that decision to do that, hopefully it's been a conscious decision and not accidental. Now, some of that income coming back at you might be a return of your own capital. Some of it could be treated as short-term capital gains, and then some of it could be treated as long-term gains, or some of it may be a blended mix of all three. Now, before you buy a covered call ETF inside a taxable account, you got to know how the fund's distributions are handled. And so the fund provider will give you this information. You go to their site, just using QYLD as an example. This is from Global X. This is a covered call ETF. And they've done a very, very good job of explaining how this particular ETF treats its income distributions for tax purposes. And I'm going to provide, again, that link in the description section below to this report. You can read it, digest it. It gets very, very granular and detailed, more so than I want to get in this video, because it's a very fangled, dull topic, and one that that I think you can better be equipped for by just doing a little bit of reading on your own. But again, I think if you don't want to have all of this complexity with regard to taxes in your life, then the quick answer, again, Paul, is just to take these covered call ETFs, keep them in a tax-deferred account or tax-free account, and that way you don't have to worry about it. Let's go to our next. Oh, well, you know what? I'm not done with answering this question, because I just thought about something, Paul. And this is something that I think is important to add to this discussion that you raised, and that is the fact that when you think about investments and where all the money that you could keep your, or all the places you could keep your money, you basically have 2 layers of tax efficiency. The first layer is correct tax positioning, and then layer 2 is proper asset location. So what am I talking about here? So now let's just talk about proper asset location, because we're going to talk about correct tax positioning in a second. But proper asset location is where most investors and financial advisors have all of their attention. They're focused so much on this particular layer of tax efficient investing that they completely miss number 1. They completely miss correct tax positioning, which, by the way, is even more important than number 2. They're both important, but number 1, layer 1, is way more important compared to layer 2. Proper asset location simply means taking tax inefficient assets, things that are not necessarily taxed as favorably. For example, real estate or commodities, or those covered call ETFs that we just talked about, right? Those are tax inefficient types of assets. From an asset location perspective, it's best to hold those in a tax deferred or tax free type of account. That's one layer of what we're talking about here, tax efficient investing. Now I want to talk about layer 1, which is correct tax positioning, which is what 100% of investors and 100% of advisors, well, not 100%, but let's just say 99% miss. So let's talk about correct asset positioning, right? So you got 3 places that your money can be. This chart illustrates the only three containers where your money can be. Now, I don't care how rich or how poor you are. There are only three places that those assets can be held at from a tax perspective. You got your taxable bucket, you got your tax deferred bucket, and then your tax free. And these are some examples that I've listed here of those types of assets. Now, the question becomes, well, what is the right amount that should be earmarked for each of these containers so that you can have a maximum tax-friendly type of outcome that causes you to pay the least amount of income taxes in a legal way? Well, based upon my own research, based upon my own experience, and the portfolio report cards that I've done, I continue to see the same mistakes repeated over and over again, with most people having way too much money located in their taxable and their tax-deferred buckets, number 1 and 2. And so this needlessly exposes them to rising tax rates. And that's the environment we're heading into, higher income tax rates. And yet most people have the bulk of their net worth in the two buckets that are most acutely at risk and threatened by higher income tax rates. And so the answer to the remedy is to get more of your net worth into the tax-free zone, which is Roth IRA, Roth conversions, Roth 401k. And then you can see each of these buckets in the green, as you can see, has an ideal target or ideal balance, a mathematically ideal balance. And each of you out there has a unique mathematical balance or ideal amount, an exact number. And so that's what I do at portfolioreportcard.com is we try to, first of all, before we get into the granular specifics of what the mathematical numbers are for you, we try to first determine if there's even a problem in the first place in terms of tax efficiency. And again, this is where most of the problems reside, is with this massive imbalance where most of people's assets and savings are in containers 1 and 2, and then little or nothing in container 3. So that was a long-winded answer, Paul. And, I'll be doing more discussions and videos on this. I've talked about it quite extensively in the portfolio report cards that I've done. You can check out that playlist. I've got it labeled as portfolio report card on this channel and see some of those episodes. I'll also provide a link to that in the description section below. One final reminder for today, I've got a new monthly video and podcast series called First Look ETF with the New York Stock Exchange. I'm producing this show, and the first episode is going to be released on this channel, ETF Guide TV, on Monday. And the program's hosted by Stephanie Stanton. She's an ETF reporter at ETF Guide. You'll get a chance to meet her, and I know you're going to love her. She's fantastic. The First Look ETF program is going to be monthly. It's going to be focused on brand new ETFs and all the innovation, and along with investment opportunities that is creating for each and every one of us. So be sure to catch it. First Look ETF. It's also a podcast, so you can listen that way, or you can watch the show, whatever is most convenient for you. So before we go, if you have any questions that you'd like to ask me, you can post them in the comment section below, and I will address them in our next Q&A session. Again, I'll be glad to answer your questions about retirement planning, Social Security, asset allocation, any specific ETFs, and I'll be happy to provide you my own insights and my own takes into what the proper approach is in order to help you get ahead and stay ahead. Now, be sure to subscribe to our channel. Don't forget to hit the description section below. I offer free ebooks, online classes, and a portfolio grading service. I'm DeLegge with ETF Guide TV. Thanks for watching. We'll see you next time.